The market's nosediving, your portfolio is bleeding red, and your gut, your very soul, is screaming, sell. You know the feeling. Every headline, every news alert, every worried text from a friend confirms it. The world is ending, and your life savings are going down with the ship. While everyone else is frantically hitting the sell button, I'm doing the exact opposite. Why? Because my biggest profits have always come from moments just like this. They come from your panic. That sounds harsh, but it's the brutal, unvarnished truth of the stock market. Your instinct to run for the exit during a crash is the single most destructive force to your wealth, but it doesn't have to be. In the next few minutes, I'm going to show you how to turn off that panic switch and turn on the part of your brain that sees a massive opportunity where everyone else sees nothing but fear. This isn't some secret Wall Street trick. It's a fundamental principle from the most successful investor of all time, Warren Buffett, who famously said, "The stock market is a device for transferring money from the impatient to the patient." And nothing makes an investor more impatient than fear. Panic selling is how that transfer happens. It's you selling your stake in a great company at a fire sale price directly to someone who has been waiting for this exact moment. But you can be on the other side of that transaction. You can learn to see a sea of red not as a disaster, but as the biggest sale you'll see all year. This isn't about being reckless, it's about being prepared. This is the ultimate guide to capitalizing on market chaos. This is how you stop being the person who sells at the bottom and become the person who buys there. The first strategy isn't a tactic, it's a complete rewiring of your brain. You have to adopt the contrarian mindset. In short, it means you learn to go against the herd. You buy when everyone is selling in a panic, and you take profits when everyone else is buying in a frenzy of greed. It's the living embodiment of Buffett's other famous line, be fearful when others are greedy and greedy when others are fearful. Look, we're all wired for herd behavior. For thousands of years, sticking with the tribe meant survival. When everyone ran from a tiger, you ran too. If you didn't, you got eaten. But in the stock market, that same instinct is a catastrophic liability. When the market soars, herd behavior creates FOMO, fear of missing out. People pile into stocks at insane prices because their neighbor just bought a boat. They're buying at the peak of greed. When the market crashes, that same instinct triggers a stampede for the exits. This is what creates market bottoms. A contrarian investor understands this psychological flaw and actively uses it to their advantage. They know that market sentiment is a pendulum that swings from irrational euphoria to unjustified despair. And the greatest opportunities are always found at those extremes. Now, being a contrarian isn't just doing the opposite of the crowd for the sake of it. That's not investing, that's just being stubborn. A real contrarian strategy is built on logic when everyone else is running on pure emotion. It's having the courage to buy a company, not because it's popular, but because you've done the work. You know it's valuable. And the market, in its panic, has temporarily forgotten that fact. This mindset is tough. It will feel weird. Your friends will think you're crazy. You will doubt yourself. But this is the price of admission for getting superior returns. You have to be the person who calmly walks into the store while everyone else is running out screaming, "Fire!" because you've done your homework and you know the building is sound and everything inside is now 50% off. Be greedy when others are fearful is a great line, but it's useless without a plan. Your emotions will absolutely steamroll you if you don't know what to be greedy for. That's why the second strategy is to build a crash watch list before the market ever starts to fall. A crash watch list is your curated shopping list of phenomenal companies you'd love to own, but whose stock prices are currently just too darn expensive. These are your dream stocks, the industry titans, the innovators, the companies with unbreakable competitive advantages and rock solid finances. Panic is not the time for research. When the market is in a free fall, you won't have the clarity to analyze a company's debt to equity ratio. You'll be running on adrenaline and you'll either freeze up and do nothing, or worse, you'll start bargain hunting for garbage stocks just because they've fallen the most. A falling price doesn't make a bad company a good investment. The real work is done during times of calm. You spend the bull market identifying these wonderful businesses. You study them, you read their reports, you understand what makes them tick, you figure out what you believe they're truly worth. And then you wait. Think of yourself as a professional art collector. You've identified a Picasso you want. You know its history, its quality, and what it's actually worth. But it's currently priced at a level you can't justify. You don't just move on. You put it on your watch list and wait for a moment of chaos, a financial crisis, a panicked seller to hopefully snag that masterpiece at a fair price. This prep work is what gives you courage. When the crash finally comes and a stock on your list drops 30%, 40%, or even 50%, you won't feel panic. You'll feel a jolt of excitement. This is the moment you've been waiting for. You won't have to guess if it's a good company. You already know it is. Your only question will be, is the price now a screaming buy? Without this watch list, you're just a tourist in a bear market. With it, you're a hunter. This brings us to the most foundational concept in all of investing, understanding the massive difference between a stock's price and its intrinsic value. People confuse them all the time, but they are not the same thing. And this distinction is the key to getting rich during a downturn. As Buffett put it simply, price is what you pay, value is what you get. A stock's price is just the last number someone agreed to trade it for. It's flighty and emotional, driven by headlines, algorithms, and gut feelings. A company's intrinsic value, on the other hand, is what the business itself is actually worth. It's the sum of all the money it will ever make, the strength of its brand, the quality of its leadership, and its position in the market. Value is based on cold, hard business facts, and it's far more stable than price. During a bull market, greed can push the price far above its real value. But in a bear market, fear can drag the price far below its value. That gap is your opportunity. A market crash doesn't mean that the best companies in the world suddenly became terrible businesses. Did Microsoft's dominance in software disappear overnight? Did Coca-Cola's brand suddenly become worthless? Of course not. But their stock prices might fall as if they did. Imagine a high-quality, durable winter coat that's really worth $500. It's the middle of summer, so the store puts it on clearance for $250. The value of the coat didn't change. It's still a $500 coat, only the price changed. Buying that coat for $250 is a fantastic deal. This is exactly how you need to see the stock market during a crash. The panic is the summer heat. The stocks of great companies are the winter coats on clearance. Your job is to ignore the weather and focus on the quality of the coat. While everyone else is panic selling because the price is falling, you should be eagerly buying because the price has fallen below its true value. All right, let's get tactical. To be a good contrarian, you need a way to measure the very fear you're betting against. The best tool for this is the SIBO Volatility Index, ticker symbol VIX. It's famously known as the fear index. The VIX doesn't predict which way the market is going. Instead, it measures the expected choppiness or volatility. In simple terms, it's a real-time gauge of how much fear is coursing through the market's veins. When the VIX is low, investors are complacent. When the VX is high, investors are terrified. A normal, calm market might have a VX around 20. But during a full-blown crash, like in 2008 or 2020, the VIX can surge to insane levels, even above 80. For a contrarian, a spiking VIX isn't a reason to run. It's a call to action. It's a giant flashing neon sign that says maximum pessimism is here. It's the quantitative proof of Buffett's advice to be greedy. When you see the VIX spiking to extreme levels, say over 30 or 40, it's a strong indicator that fear is peaking and that the best buying opportunities are likely appearing. Let's be crystal clear. The VIX is not a magical crystal ball. It won't tell you the exact bottom. Nothing can. But history shows that when the VIX hits its peak, the market is often at or very near a bottom. It's an incredibly effective tool for identifying periods of maximum pain, which is exactly when you want to be shopping. So how do you use it? You keep an eye on it. When it starts climbing into crazy territory, you know it's time to pull out your Crash Watchlist. While everyone else sees a high VIX and runs for the hills, you see it and think, the sale is on. We can talk strategy all day, but none of it matters if you can't win the battle between your own ears. The most important part of profiting from panic is mastering your own psychology, because during a crash, your brain is your own worst enemy. Fear is a primal instinct. When your portfolio is down 30%, your brain's fear center lights up. It doesn't know the difference between a charging tiger and a market downturn. It just screams danger and tells you to run. This is what leads to panic selling at the absolute worst possible time. The secret isn't to eliminate fear. That's impossible. The secret is to reframe it. You have to learn to treat fear as a signal, not as a command. Let it be the seatbelt that reminds you to double check your research, but never, ever let it grab the steering wheel. So how do you build this discipline? First, have a plan before the crisis, like we already discussed. A predefined plan is the ultimate antidote to emotional decision making. When you have rules, you don't have to think in the heat of the moment, you just execute. Second, learn to hit the pause button. Seriously, Simple things like taking a few deep breaths or even journaling can help you create a gap between the feeling of fear and the action of selling. Write down what's happening and why you're scared. This simple act can give you the clarity to see if you're reacting to real risk or just raw emotion. And hey, before we get to the final, most practical strategies, if you're getting value from this guide, do me a favor and hit that subscribe button. This channel is all about giving you the tools to build real long-term wealth, and it helps me keep making content just like this. Ultimately, building this mental toughness is like building a muscle. Every time you live through a market dip and follow your plan instead of your fear, that muscle gets stronger. You start to see yourself not as someone who's scared of volatility, but as an investor who uses it. Okay, you've got the mindset, but you also need a practical mechanical system for actually deploying your money during a crash. You need a system that removes the emotional strain. The two best tools for this are dollar cost averaging and smart position sizing. First, dollar cost averaging, or DCA. This is just investing a fixed amount of money into a stock at regular intervals, no matter what the price is doing. Instead of trying to dump a huge lump sum at the perfect bottom, which is impossible, you break it up into smaller, less scary chunks. Let's say you have $10,000 ready for a stock on your watch list. Instead of investing it all at once, you could invest $2,000 a week for 5 weeks as the price falls. This does two amazing things. Psychologically, it makes it way easier to start buying. It's much less daunting to commit a small piece of your cash than to go all in on what looks like a falling knife. But more importantly, it turns volatility into your friend. As the stock gets cheaper, your fixed $2,000 buys you more and more shares. This automatically lowers your average cost per share, setting you up for bigger profits on the rebound. Second, position sizing. How much you bet on any single idea is critical. A great way to manage your fear is to start small. You can be 100% convinced a stock is a great buy, but if your position is so huge that the daily swings make you sick, you're going to bail on your plan. Start with a smaller position that lets you sleep at night. You can always add to it later as your conviction grows or the market starts to stabilize. This mechanical approach, combining systematic buying with smart risk management, is how you turn your contrarian theory into disciplined, real-world action. The final strategy is a mental hurdle you have to clear. You must completely give up on trying to time the exact bottom. Trying to pinpoint the absolute lowest price during a crash is a fool's errand. It's an exercise in ego, not smart investing, and it's why most people miss the rebound entirely. Here's how it usually goes. A great company from your watch list is down 40%. Your research shows it's an incredible value, but you hesitate. You think, maybe it'll go down another 10%. I'll wait. So you wait. The stock dips another 5%, but then boom, a piece of good news hits and the stock rips 15% higher in 2 days. By the time you realize the bottom is in, you've already missed a huge chunk of the recovery. In your quest for the perfect entry, you missed a fantastic one. This is where so many people mess up. The biggest risk in a bear market isn't buying a little too early. It's being so paralyzed by the fear of not being perfect that you miss the opportunity altogether. The most explosive gains of a new bull market happen in the first few days and weeks off the bottom. If you're sitting on the sidelines, you miss them. Remember, your goal isn't to buy at the lowest price. Your goal is to buy at a great price. If a company you valued at $100 per share is trading for $50, that's a win. Whether the absolute bottom ends up being $50, $45, or $48.23 is completely irrelevant in the long run. This is another reason DCA is so powerful. It forces you to abandon market timing. By deploying capital as the price falls, you accept that you won't catch the exact bottom. Instead, you pretty much guarantee your average price will be somewhere in the bottoming range, and that's all you need to generate phenomenal returns. So let go of the ego. Focus on value, not bottoms. Be happy with buying a great business at a great price, and you'll be set. So the next time the market starts to implode, when the headlines are screaming and your portfolio is a sea of red, you won't feel that same gut-wrenching fear, because now you have a playbook. You know that this chaos isn't a threat to your wealth, but the single greatest opportunity to build it. You know that widespread panic is the price of admission for a once-in-a-decade sale. You'll have your watch list ready. You'll watch the fear index with anticipation, not anxiety. You'll use disciplined systems to buy systematically and unemotionally, and you will let go of the impossible dream of timing the perfect bottom because you'll be too busy buying incredible companies at a massive discount. Market crashes are not something to be survived, they are something to be capitalized on. They are the moments when fortunes are made. By flipping your psychological switch from defense to offense, you ensure that the next time everyone else is panicking, you'll be getting ready to profit. If this helped you think differently about market chaos, hit that like button and make sure you're subscribed for more strategies on how to build your wealth by acting like a true investor. See you in the next one.